People seem to think that everybody who makes $50,000 a year has lower financial health than people who make $150,000 a year. And guess what? It's not true.
Hi, everybody, and welcome to Smarter Money. My name is Vlad Sherbatov, and today we have a very special guest on the show. Joining us today is a global influencer on fintech and banking. He's an author of a popular book called Smarter Bank, and he's a weekly contributor to Forbes magazine, where he writes a weekly segment called Fintech Snark Tank. He's written countless white papers and research studies on the financial industry, and he's the managing director of fintech research at Cornerstone Advisors. Please welcome the fintech sommelier, Ron Shevlin.
Thank you, Vlad. Great to be here. Appreciate you having me on.
Ron, how did fintech and the financial sector become such a passion of yours?
Kind of by accident, Vlad. I was actually in management consulting for a very long time, 12 years. Hated it, hated being on the road all the time, and was looking for some other alternative and came across Forrester Research, the big technology analyst firm here in the Boston area where I live. And I was doing a lot of IT strategy work at the time for large corporations, working a lot with chief information officers. And Forrester had an opening on their team that did research for CIOs on how to manage IT. So that was a really good fit. And it was a great fit for me because it was really doing a lot of work I'd like to do. It was basically consulting with a different form of deliverable. Instead of sitting across from one client and saying, here's what you need to do, this was about writing stuff to the broader audience. And it was great because it involved a whole lot less travel. And when we did travel, it was to conferences in nice places. So it was a good gig. After a couple years, they came to me and said, hey, how would you like to be the research director for the financial services team? Now, I have to admit, I've never worked a day in my life in a bank, had financial services clients throughout my consulting career and even in my early part of Forrester, but I was ready for a new challenge. And I said, sure. You know, what I didn't know at the time, Vlad, was that the reason they asked me to be the research director was because nobody else was crazy enough to take that job. It's a tough job being both research director and still writing. But that got me into focusing strictly on banks and financial services and fintech, although that wasn't really the label back then in the late 90s, early 2000s. And then after a couple of years, I stepped out of that, went back to being an analyst and really focusing on a lot of consumer studies, consumer behavior, consumer research, and this budding world of financial technology and seeing all the new providers come into the market. And I basically have kind of stuck with that now since the early 2000s. So we didn't call it fintech back then, but that was basically what I've been doing now for more than 20 years.
And how do you go about your research? Is it through surveys? How do you extract these trends and findings that you've been doing for a number of years now?
We do a lot of consumer surveys. We also do a lot of surveys of financial executives themselves. And for any particular research report that we are producing, or that I am producing, not just we, but that may involve just interviews with people, experts in the space. But that's just the methodology. What I'm really trying to focus on is answer a few questions that senior executives in both the fintech companies and the financial services institutions themselves have, which is generally things like, what's coming down the line? What's changing? How is this going to impact my business? How is this going to impact the industry? And I have to say that, interestingly, despite the fact that I've never really worked for a firm in the financial services industry, my consulting background, where I worked with firms from a wide range of industries, has really helped a lot because you really see the changes and that other industries have gone through, and it helps translate that to financial services. So it's really less about the survey or the methodology of the research that drives this than answering the questions or trying to address the questions, what's going to change and what is the impact going to be, And one of the things that kind of really drives my research, and I have to give Forrester credit for this, there was a term at Forrester called "what it means," and I've translated that in the work I do to "so what." Yeah, you can survey 1,000 consumers, and they'll tell you blah 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 blah. But the key for what I do is to answer the question, so what? What's the so what of this?
I think that makes a lot of sense. And let's dive into some of these answers. You recently published a report of what's going on in banking in 2021 report. Can you give us just a quick breakdown of some of the top must-know trends that you see coming down the line that are going to dominate the conversation in the next little while in the financial industry?
Sure. The What's Going On survey was actually a survey of mid-sized financial institutions in the US to understand what were their priorities from both a business and technology perspective going to be in 2021. And I've done this now for about 5-6 years straight, so I've got a good year-over-year view. There are a couple of things that are clearly emerging as trends from financial services, and this is really from a banking perspective, more specifically, not so much wealth management or insurance. Number one, there is still a very, very strong focus on digital sales and digital account opening. I think last year was the straw that broke the camel's back, Vlad, in terms of getting financial services executives here in the US to really understand that the branch wasn't as important as they thought it was. Yes, they've always seen a lot of branch activity, and yes, a lot of accounts were being opened up in branches. But I think last year made them understand that those applications and products that were opened up in branches weren't opened there because consumers wanted to. It was because consumers had to. It was because the digital experience was so bad, or maybe even non-existent altogether, it forced people into the branches to do these things. And last year with the pandemic, as branches closed, and many are still actually temporarily shut down, if not permanently shut down, is still forcing consumers to use the digital channels. So digital account opening and digital sales has really emerged as a very high priority for financial institutions. A second one is really the impact of fintech. And this, I think, is a very important evolution, Vlad. When fintech companies, neobanks, challenger banks, started coming out around 2010, 2011, they beat their chest and go, well, we're so superior. We're going to provide a better customer experience, and it's going to be mobile, and it's going to be great, and we're going to put all these banks out of business. And of course, they didn't. What's kind of really evolved is that the fintech players are co-opting with the traditional financial institutions. So finding ways from a bank perspective to not just integrate and not just partner with, but to really leverage what a fintech company can bring them in terms of new products and services, in terms of new ways of doing business, new ways of providing customer value, is a very top of mind trend for a lot of the financial institutions these days, figuring out how to leverage this, not just as a defensive move to prevent being disrupted, but as an offensive move to utilize those services. And the third big trend that I'd point to is kind of, and it follows a little bit along the lines of the fintech partnership. But if you look at the way banking has evolved over the past 10, 15, and maybe even 20 years or so, there is such a high degree of interconnectedness between banks and their providers and suppliers, between banks, of course, and their customers, but between banks and the environment. That could be governmental agencies, it could be suppliers of data, it could be technology providers. And so streamlining those points of interconnection with things like APIs and other integration capabilities has become very top of mind and a very top priority for a lot of financial institutions.
How are they going about this? And if we look at the first one, let's say the digital sales and account opening, where are they right now in terms of whether they need to be to get to that digital transformation phase where you feel like you would be in a good place? I mean, does it right now start and end with account opening, or does it go much deeper than that already?
So it's a great question, and there's no easy answer to that because a lot of banks and credit unions too, you got to throw them into the mix, are kind of all over the map with this. There are probably a lot, and I would say probably too many financial institutions that approach digital account opening as a kind of a once and done kind of a thing. And this is two aspects to this. One is they treat it as sort of, okay, there's a system and application that we need to provide. Let's go out, let's go look at the vendors. Okay, we'll choose vendor A, we put it in, good, we're done. A couple of problems with that. Number one is that no matter what you put in on day one, it needs to evolve. As new capabilities come, as new needs emerge, banks really need to think about these systems and technologies almost as products with a product roadmap. The vendors have product roadmaps for their applications and systems, but the banks need to be thinking about this less from a technology app perspective and more from a process perspective, the process of digital account opening. And so there's not enough that really think in terms of, okay, it isn't just about opening the account, it's about onboarding. It's about the onboarding process as well. And then the smarter ones realize, well, wait, it's really not just about account opening and onboarding as well. It's about transitioning to a deeper part engagement with that consumer. That's probably going to happen more from a digital perspective than it is a branch perspective. There's only so many times a month a person is going to come into the branch to interact with you, especially for reasons other than having a problem they want resolved. So how do you drive digital engagement? And that's the bigger umbrella and challenge that the banks need to be thinking about. Is the digital account opening is not just about opening the account. It's the first step in an engagement strategy. And, when you ask where are banks on this and so forth, they're all over the map. Some are seeing it too narrowly. Some are doing it broader with onboarding. And I would say probably only a handful at this point, or maybe not a handful, but not enough, and probably growing though, see that you really got to think of it more broadly in terms of how it fits in an overall digital engagement strategy.
When you say digital engagement for a financial brand, what do you mean by that?
Anything that fits anywhere between a interaction, a transaction. I mean, look, checking your account balance is probably in terms of the level of emotional engagement that somebody has with the bank. For people who, are not at danger of being at zero all the time, checking your account balance is kind of low, emotional involvement or engagement. But that is still engagement, and especially for people who are at the low end of the income spectrum, or have, especially like gig workers whose incomes, are very unpredictable and variable. Knowing that account balance is important, having it access, but taking it to the next step. Well, what do I do about this? And so, sometimes you might have a question about something that comes up and you want to ask. Having that ability to ask a question and get an answer, maybe through a chat bot or something like that, is a form of digital engagement. But what I think of is going up the scale to the more emotionally involved things, come around, well, what should I do? What should I do to better manage my financial life? You can't just walk into the branch 5 times a week and say, well, what should I do? Let's just talk about this. But you can do that online. You can do that through digital channels. There's, whether it's through content, whether it's through watching videos of advisors talk about things, whether it's looking at data and how your financial life compares to other people. There's so many different ways of engaging consumers and customers through the digital channel that goes far beyond what you could do on a face-to-face basis. And, I wouldn't actually throw away the face-to-face basis either, Vlad. Everybody talks about branches not being dead or being dead. I definitely think we're on the path of closing down the branches. And let me explain why. Let's take a step back and answer the question, why do we have branches in the first place? And one of the reasons, I guess it goes back maybe 70, 80 years ago at this point, I really don't know. But some smart person in some bank said, hey, you know what? As people are moving out to the suburbs from the urban areas, it's a pain in the neck for them to have to come into the city and get to this one big building we have here in the center of the city to have them interact with us. Why don't we build a smaller building out closer to where they are, put a few people in there, and make it more convenient for them? It was a convenience aspect. And it was a way of having an ability for customers to interact with people from the bank in a more convenient way. Now, as technology has evolved, what happened? Well, it was a lot easier to pick up the phone and call. So the banks developed huge call centers over time to make it easy. It was all about convenience and also about staff and cost, because this way you didn't have to have 1 million people in the branches. You could have a team of people in the call center. But as the digital channels have been created and evolved, this is where we have stopped seeing the evolution. And, I would put out to you, Vlad, that we are sitting here today using a technology that enables us to have a face-to-face conversation without us having to be in the same room. We're hundreds of miles apart from each other. This is pretty easy and convenient, right? Why aren't banks doing this? Why aren't banks enabling their customers to have video chats with the people that they need to contact? I'm the first person to say, I hate getting on the phone. I don't want to talk to somebody on the phone. I can't deal with that. But this is a great way of interacting. And by the way, if you needed to see, well, Ron, what are you talking about when you say that? What's on your statement? I'm going to say, I can pop that right up. Right. I can go here. We can share the screen. We can do this. This technology obviates the need for the branch. Last point I'd make on this, there was a bank CEO here in the U.S. who had started a bank back in the 70s that became very well known for its branch service. And in the early 2000s, he was interviewed by one of the big bank magazines or publications, and they asked him, well, why aren't you making big investments in the internet? And he said, because nobody wants a relationship with a machine. And he might have a good point there, but my retort to him would be, but nobody wants a relationship with a brick. It's not about the brick and mortar that people want from a branch, it's the interaction. And reality today is that technology provides a better mechanism, not just for engaging people on a day-to-day basis when it's not intermediated by another person, but even when it is intermediated by another person. So this is why digital engagement as a whole becomes so important, because it's not just about looking at an online screen or online content. It also is about providing capabilities to provide the human interaction. And that's why this sort of human plus digital becomes so important for banks going forward.
What begs the question is, now that it's so obvious that you need to have those more personal communication points or accessibility with the financial brands, what is the main obstacle that is stopping them from adopting these technologies and being much more active and much more invested into it?
I think there's not really barriers to stopping it. There's really, I think, internal issues that they have from an organizational perspective, especially the larger banks. For you in Canada, you're mostly dominated by 5 very large financial institutions who are very complex from an organizational perspective in terms of organizational structure and design. Here in the US, we've got thousands of financial institutions, much fewer that are of huge size. But really, once you get to about $50 billion in assets and above here in the US, you're still getting to be kind of a large company. And part of the problems and challenges they have, Vlad, is really an organizational issue. And I think there's a few things. First of all, from an organizational perspective, think about how things like budgeting gets done. You get a budget that gets set at some point in time, and then next year you fight to get a higher budget for your department or division. And because the org structures in a lot of banks are channel driven, there are groups that manage the online channels, groups that manage the branches, a group that manages the contact center and so forth. Each fights for their budget. And yeah, they might not get the increase that they wanted, or they may have to take a little bit of a decrease. Those are not that impactful year over year. Digital channels certainly seeing more investment, but we're not seeing a lot of the money coming out of the branches per se, or out of the contact centers. So they're not actively managing and forcing the shift from one channel to another. Another big barrier, I think, has nothing to do even with the organizational structure, or even with technology itself, but just the human aspect to this. Who runs these large banks? Well, they tend to be people of at least a certain age. You don't see a lot of 23 and 24-year-olds running large banks, and that's just the way it goes and the way it should go. You need some experience in a business before you can manage a large organization. So most of the people at the top of large banks have been there 20, 30, even 40 years. You've been around for 20, 30, 40 years. You begin to develop ingrained beliefs about what works and what doesn't work. And no amount of consulting hype, no amount of consumer studies and surveys is going to get you to change your opinion in the short term. You need a period of time of seeing, hey, this is not working anymore. And I think we're at the point where they're getting that now. So it's taken 7, 8 years of this fintech emergence. And at first it was like, yeah, they're small. This is not really, going to impact us too. Yeah, it's still on the fringes. And then it becomes kind of more mainstream. And then they really start to feel the pressure. So we're only really at the beginning of that shift in the mental approach to this. And I think we're also at the precipice from a generational shift. The baby boomers who have been in charge for the past 10 years, are now, a minimum of, 56, 57 years old, going up to 75, and they're pretty much out, retired already. So we're at the precipice of kind of shifting the power to the Gen Xers and the older millennials who are now, believe it or not, 40 years old. So, that's helping to kind of knock down the barriers. And, this is not stuff that anybody couldn't predict, Vlad. I started my consulting career back in the mid-'80s. I remember having a PC my first job out of school was in a hospital. I didn't even mention that. And I remember coming into the hospital, and there was a approval for a IBM System 5520 word processing system. No, I think that's what it was. I could be making that up, I remember going to the executive director of the hospital saying, why are we spending all this money on a bunch of word processing systems for the administrative assistants when we can spend that money and get 15 PCs that we could be doing a whole lot more with? And this guy said, okay, only one thing is you're going to be in charge of making sure that stuff works. And so, what I learned back then was you got a lot of people back then who didn't want to put their hands on a PC. They're like, I'm not a secretary. I don't type. That is such a foreign concept today. Everybody uses a keyboard. Everybody uses a PC, a laptop, or something like that. And so that was a very similar, mental shift back then. And it was at the point where the pre-baby boomers were in charge, and when the baby boomers were starting to take over. And that's where we are today. The mental shift is happening, and the generational shift is happening. So we're going to see those barriers to change really come down over the course of this decade.
I think that's so interesting. So what you're saying is that as the generational gap sort of churns and changes itself over that period of time, the attitudes within the internal organizations will start driving decisions in a slightly different way that maybe before were more influenced by, past methodologies and mentalities.
It's very parallel to what happened with PCs back in the 80s. Another quick story is we're doing a consulting project for a very large company down in Miami, Florida. And the IT staff came to us and said, our CEO is so adamantly against using a PC. Do you guys have any ideas of how we can get him to use a PC so he can see the benefits of this? And I wish I could take credit for this, and I can't, because it was one of my colleagues who came up with what I thought was one of the most brilliant ideas I've ever seen in consulting. And the guy said, give PCs to his grandchildren. And so they gave PCs to his grandchildren, who then said, Grandpa, let's do email. And so Grandpa learned how to do email. Grandpa,
Right.
the CEO of a huge multi-billion Fortune 50 company, and realized, oh, we can do this stuff. We can use this for our business. And it was all because he got into it just to email his grandchildren.
Unbelievable, right? Like just in that example itself, the younger generation literally pulled them across the fence.
Yeah. And I actually have seen this more recently I was at a bank's board of directors meeting, and one director starts going off on this rant saying, we need to be on Facebook. My granddaughter's on Facebook. My granddaughter messages me on Facebook. And if they are all doing this, we need to be on Facebook. And again, if it wasn't for his grandchild, he would never have thought of mentioning Facebook.
On the same line of thinking, do you think that major financial institutions and mid-sized financial institutions should be on TikTok?
It's not an easy. It's not the right question, Vlad. The question isn't should they be on it. It's why would you want to be on it? Who is it right for? There's going to be a lot of financial institutions that it isn't right for them to be on TikTok because it doesn't match with their target market. It doesn't match with the products and services that they offer. So there's not a blanket yes or no answer to that. I hate to be the consultant who always says it depends, but it depends. But it's not bad to experiment with certain of these new social media platforms and channels that come out and see what works and doesn't work. That's the more important point. It's not about should I be on it, yes or no. The answer should be, well, go experiment with it and figure out if it helps you meet your target audience, or maybe it actually helps you uncover a target market that you didn't even know resonated with you. So, if you're a bank, most of them are looking, if you simply were a bank, and especially in the US, looking at your customer base and not the large banks. I mean, in here in the US, Vlad, the large banks, Chase, Bank of America, Wells Fargo, have a incredibly disproportionately high percentage of market share among Gen Zers and millennials. It's absolutely ridiculous. And so every other bank is looking at their customer base and realizing that the average age is 48, 49, 50. That's the average age, which means they got a hell of a lot of customers who are 60 to 80 years old. And I don't think a lot of 60 to 80-year-olds are on TikTok, to tell you the truth. So the question is, what are your marketing objectives? Is it to increase the business and the needs you've got with people who are 55 to 80 years old? Or are you going after a need to grow your base of customers in the 20 to 25-year-old range? Challenge is, look, you just simply don't make as much money from the 20 to 25-year-old as you do from the 55 to 80-year-old because of the lifestyle and the amount of money they have after 40, 50 years of working and saving. So, it's the question isn't what social media platform do we use? The question has to start with what are our business needs? What are our business objectives? Where do we have to get? Where do we have to grow? Who do we have to grow with? Who's going to drive our growth? And then say, okay, if that's what we're going to do, then how do we reach those people? And if you come to the conclusion, hey, we're not going to drive a lot of revenue in the short term from people in the 20 to 25-year-old range, but they do spend money on this and we can provide them that, then yeah, being on TikTok could be very important, especially if you are also looking to portray yourself as being leading edge, maybe a little kind of not seriousness, you know what I mean? But if you want to be the dour, we're wealth management, very serious, then I don't think you want to be on TikTok. So, the question can't start with, should we be on TikTok? The question needs to start with, what's our business strategy? What are our objectives? What are we trying to achieve? And how do we best achieve that? And if the answer is TikTok, damn it, go for it.
I think that makes a lot of sense. I mean, it has to, whatever strategy you choose to execute, it needs to be aligned with your brand guidelines, your target segment, the products that you're offering as well. So you must have worked with a lot of marketers at financial brands. How would you approach typically marketing financial products?
Yeah, Vlad, there's a problem that financial brand marketers have to overcome. And you just kind of hinted at the problem when you said marketing financial products. This is my personal view. I think if you look at what fintech has brought to the table, a lot of the fintech companies, especially like challenger banks like Chime and Varo and so forth, they don't talk about products. Because to a bank, a product is a checking account, a savings account. They're very stuck in the mentality that there's an account and that's their product. And we have to market the product. What the fintechs market and talk about is experience and value. It's what do I get from this? Forget that there's an account. And I associate this a lot with Chime in particular, and I call it, and I'm sure there's probably a better word for it, but for lack of a better word, featureization. Chime talks about early access to your direct deposit. They talk about Spot Me, money that will get you over the overdraft charge. They've got a credit builder credit card. They're not marketing products. They're marketing the experience. They're marketing the value they provide. The account or the product is just this mechanism, this construct we have to have in the industry in order to deliver something. But the traditional financial brand marketers and many of the large banks are stuck in this mentality of marketing products versus marketing service, the service, the value that's provided by the mechanism we call the product. And so, what's happened too is we've kind of even jumped the gun from that. The auto industry has done the same thing. Have you seen any car commercials in the past couple of years? They don't talk about the features of the car anymore. It's, we have global impact on, on this, or Subaru, all about the dogs. Well, there's nothing to do with the car. And in financial services, we've kind of almost gotten the same way. It's about achieving your financial dreams. With a checking account? Seriously? Or savings account with a 0.005 interest rate and you're going to achieve your dreams? Meanwhile, what's come along? Are companies like Acorns and Digit and Capital who provide tools to automate savings and figure out how much more could you be saving based on your spending behavior and income. And by the way, don't worry about it. We can figure it out. We'll take that money. We'll put it right into a savings account for you. And so while the banks are still advertising, hey, you can get a 0.1% interest rate on a savings account, which is 10 times better than what our competition's offering, you got new fintechs coming out going, don't worry about the rate you're getting. You need to be worried about how much you're actually saving because we can help you do a whole lot more. So it's a very different kind of attitude. And I think this is the hurdle that many financial brand marketers have to get over. But again, Vlad, let's go back to what's the root cause of the problem? The root cause of the problem is the organizational design that says, hey, we're going to budget X amount of our marketing dollars to checking accounts and X amount of our marketing dollars to savings account and X amount to our credit card and to our wealth management group, and then you guys go off and hawk that stuff. So it's the organizational system that has kind of gelled this view of marketing the products. Fintechs come along, they don't have that baggage, and they go, well, who cares about what the product is? We're just going to push with the value that we're providing. We'll push the service that we provide, and I don't mean customer service in terms of call. I mean the service of the service delivery of the product or service that they're providing. And I think that's the big challenge that many traditional brand marketers have to overcome here.
Do you see that mentality is changing among the marketing teams at financial institutions and how they approach marketing?
No, I don't think so at all. I don't think they've gotten there yet. I think they've gotten past the let's push, the checking account thing to this more touchy-feely, let's, we help you achieve your financial dreams kinds of a thing. And to some extent, they have kind of started marketing, more digital related things, in terms of, hey, mobile banking. They're stuck, Glad, in this view that it's all about convenience, and it is about convenience. The problem is that, for lack of a better argument, there's general parity in the industry, especially among large banks, regarding the amount of convenience that they provide. So where do you go to differentiate? Well, you have to go somewhere else, and that's why like a Chime comes along and says, well, yeah, their mobile banking capability provides just as much convenience as anybody else's, and so then they go to product features like the early access to the paycheck and things like SpotMe. And that's why they do so much better than even some of their fintech competitors like Varo and so forth. It's a challenge for a lot of the big bank marketers because, the other thing that's kind of coming along here and changing the world, and I just wrote about this week, are these, what I think of as personalized banks. And it's not the one-to-one notion marketing, it's the segment-based. You've got banks here like First Boulevard that serve Black American consumers, Purple that serves disabled consumers, Tab Bank that focuses on truckers, Panacea Financial that serves young physicians. What they've uncovered, Vlad, is that there are unique needs of various segments. Good example of this is a company called Daylight that provides banking services for LGBTQ consumers. Now, to a large percentage of the population who are not LGBTQ, they look at that and go, what do they need? How would they be different? They don't understand that. And the marketers in big banks don't understand. There are unique needs. I had a buddy of mine who fits into this category recently said, my partner and I went into a bank to open an account. And when the form says, has to be jointly signed by husband and wife, what does that tell that consumer about what that bank provides? So, this is what's kind of emerging, is that there are unique needs. You would never think maybe that there were unique financial needs of young physicians. However, think about what they've gone through. They spent 8 years in school, not making a lot of money. They get out, they're in a residency, again, not making great money, but they have huge amount of student loans. So their debt to income ratios are horrible. Then they get into an early practice, they start making more money and start making good money. But they go for a loan. In fact, I was talking to one of the co-founders of Panacea, and he said that, when he started his early practice, he went to a bunch of banks to refinance his student loans. He said, not only did they offer me a rate worse than I already had, but they wanted me to have my parents co-sign the loan. He said, I'm 30 years old, I'm making decent money, but because my debt to income ratio was so poor and because my credit history wasn't there. So we are in this world where there are these unique needs, and pre-digital channel, pre-internet, pre-mobile, smartphones, it wasn't economically feasible to serve narrow niches like that because they were geographically dispersed, and the just numbers just weren't there. To become a national brand, you have to spend a lot of money. You still do, to really build a national brand. But if you're going after a smaller niche, you can be more geographically diverse these days and leverage the advantage of the digital channels to find those needles in the haystack that you're looking for without having to build branches all over the country and advertise all over the country like you used to have to do. So the big banks really struggle with this, Vlad, because there are so many underserved niches. I mentioned a few. There's environmental consumers that are being served by companies like Aspiration, and you can find a lot more examples of this. But it becomes a burden for large banks to have to establish groups who are going to focus on and establish the needs of smaller segments of the market and deliver personalized, customized solutions, products, and services for those groups. And so, the big banks are going to find that these new companies are going to chip away at their customer base for the next 5 to 6 years.
And I think you mentioned something very important is that it's personalized solutions, right? Not personalized marketing messages that are pushed to you to buy a product that's not personalized for you.
That is spot on. It's funny you mentioned that too, because that was a key part of the article I published in my Forbes blog, that it's just not personalized solutions, but that is very important. But the idea is it's not just messages either. It's about conversations. It's difficult to truly have a personalized conversation with somebody you don't know. But what happens is the banks are so focused on personalizing messages. But what happens when the customer or prospect actually responds to your message? All capabilities of personalization go out the window. But if you're daylight and you're focusing on LGBT consumers, well, again, yeah, you don't know that exact person. But because there is this, they are part of this group, and we know what the general unique needs and issues and problems and desires of this unique segment are, it makes it more easy to have that conversation and know that you're probably dealing, even though you can't do it individually. What I'm really arguing for here is segmentation. It's not that different, but the idea of the one-to-one is still so far off. And, I'm not even so sure that that's a great concept, to tell you the truth, because if we really were doing one-to-one marketing and I made you an offer based on every unique thing that I can find out about you, and you didn't accept the offer, what does it tell me? I can't do any A/B testing on a segment of one. I can't do any of the traditional sort of research things and attribution type approaches that we have, because you're a segment of one. We actually need broader segments of more than just one consumer in order to do things like A/B testing and do some trials and whatever your approach is. And so have not been convinced that one-to-one marketing is all it's made up to be. It sounds like it's something good, but practically speaking, I don't think it's the end-all be-all.
When you talk about digital engagement, and I think we kind of talk about that topic from the beginning, but it's carrying through the conversation because it has a lot to do with both marketing and the service of your product and how you go about conversing with your customers. Do you think that all of that has to be inside the actual organization or start happening once somebody already engages with a product or opens up an account? Or should financial brands be more active in starting digital engagement before that happens? So as an example, these experiences and these conversations about financial matters, answers to questions like, what should I do, also happen outside, right? They happen on different publisher websites, perhaps people reading your blogs. It could happen on aggregator sites as well. What is the role of those third-party publishers and organizations that are driving a lot of financial conversation forward? And how can financial brands leverage it to drive their digital engagement up as well?
Yeah, great question. And I'm glad you brought it up because it's really important. Historically, and it is changing somewhat, but historically, there's been this attitude, oh, we have to get people to come to us, come to our site. It used to be even worse. It was we had to drive them into the branch. But now at least there's an attitude of, oh, yeah, let's get them onto our website. Let's get them onto our mobile app. And you're never going to succeed with that. And so now, there's, okay, well, people are going to Facebook. Let's go to where people are. But why are people on Facebook? Generally speaking, they're on Facebook to interact with friends, family, that kind of stuff. Why would they go to an aggregator site? Why would they go to a blog, and not like mine, but generally, Dave Ramsey kind of a thing? Because they want to make smarter decisions about their financial lives. Now, what do financial brands typically do? They want to advertise on the site. They will say, hey, we're great. Think about the customer experience. I'm going to an aggregator site as a consumer because I want to see who are the providers. I want to get information about those providers. And I predominantly want to get independent information from them. The old world, pre-internet was if we wanted to, open up a savings account, we'd get on the phone and call 10 local banks, find out what their rate was, make the decision. Same thing with like insurance. You call around. The beauty of the aggregator side is I can go to one place and save me a hell of a lot of time to see that. But then the financial brand marketers look and say, oh, the people are going to those sites, let's advertise on those sites. But there's still a limit to how well even an aggregator site can help somebody make a decision if all they're providing them is numbers. Because what's going to happen is, there might be 30 providers in the market, 10 of them will have the same exact rate, and the other 20 will actually be close enough that, maybe there's some reason. So they have to help people not just provide information, they have to provide help and assistance on how do I make the right decision. And so financial marketers, bank marketers, need to be looking at this not in terms of, okay, let's go to where people are, but let's figure out why people go to those other places and provide content that helps them make that decision. So if I were a financial brand marketer, I would probably post content on aggregator sites that don't even really talk about my bank at all, or my bank's products or services or anything. I would recognize that what people are trying to do there is make smarter decisions. So I would post content that says, here's how to decide between providers. This message brought to you by my bank. You know what I mean? But the content itself wouldn't even, mention that. Same thing with Facebook or any other channel. You've got to look at the context in which people are using some third-party site or app and say, okay, this is what people are doing there. Let's try to become part of the conversation, not redirect the conversation, not change the conversation, and not impose our views on the conversation, but truly be part of the conversation. And, you look at Twitter, I know names. I know names because I shouldn't be mentioning names, but no names because I also can't think of, the specific names. But I see this on Twitter a lot. There are some brands that, inject themselves and just talk about themselves. And there are some brands that there's really a person behind the company name on this Twitter account, but they're very good at just being part of the conversation.
Yeah.
And not talking about themselves, but just mentioning the conversation. And you can see that there's some personality, there's an attitude there. They're funny, they're quirky, they do these kinds of things. And there's a lot of value to that, because over time people start to have a more positive affinity and view of that, because they say, well, I've been interacting with whoever it is behind the screen, the Wizard of Oz there, behind the machine, but they become part of the conversation versus trying to redirect the conversation or impose the conversation. And I've seen a couple of brands recently from a financial perspective go on Twitter, do things like, well, take this poll. If you were doing, and they think that they're becoming part of the conversation, but it's so clear that they're just doing traditional marketing stuff. You know what I mean?
Right.
So I think a lot of brands are still wrestling with how do you authentically become part of the conversation. And I know that's such an overworked word, but there really are conversations going on in Twitter a lot of times, especially the world of you got to kind of pick your spots. It's not just generic stuff, but we all have labels now. There's VC Twitter and this Twitter and politics Twitter and FinTech Twitter. And we definitely have a lot of conversations in the FinTech Twitter world, of which, the brands can be part of. Because if you really are thinking, hey, there's influencers, you want to be part of the money Twitter conversation.
Absolutely. And I think it's parallel to what you mentioned earlier. If you're thinking about marketing messages for a financial brand, you don't want to focus always on just the product and the features. You want to talk about the experience, because that resonates more with that end consumer. Same way as if you're representing your brand on social or on Twitter, for example, you can't just slam the message of, here's my website, here's my product, come visit me, here's the link. Instead, you have to, the right way, communicate and contribute meaningfully to the conversation. Because at the end of the day, people, we don't like to be sold, but we do like to buy things, right? So it's fine to have a marketing based objective that comes with participating on social platforms, but you have to go about it the right way, absolutely, or it can backfire.
Yeah.
Ron, you mentioned something about people wanting to make smarter financial decisions. And I think right now, people are more self-reliant than they've ever been before. I mean, people, as information has become more accessible just over the past number of years, thanks to the internet, thanks to social media, people have had more tools than ever before to access that information, right? Some preliminary information at least. And the quality of it has increased. And what's happened in 2020, still happening, really that trend has accelerated tremendously. So people have been driven online even more. And in particular, really, I mean, this touches on the topic of financial literacy, right? Which is a bit of a bigger topic. But the interest in financial matters has increased. And you can see that even just by the type of searches that people are doing online, the types of groups that are being created on some of the new platforms. And especially impressive is the interest among young people. And if you look at some of these platforms, like TikTok, for example, that I mentioned earlier, one of the most popular groups of celebrities on TikTok or influencers on TikTok are money coaches, like money experts that explain to people in plain terms and in short segments of time how to save better, how to get started with investing. Maybe if all you have is $50 a month to play with, how to educate yourself, which books to read, which people to follow. So if we talk about financial literacy, like what is your view on that? Should financial brands be more active in that sphere? And where do you see that going in general?
I am a big opponent of the term financial literacy. I don't think it conveys the right notion of what's needed out there. So, for example, I'm not a bad driver. If you look at my driving record and all so forth, but I'm pretty illiterate when it comes to the mechanics of the car itself. In other words, literacy is different than behavior. And behavior is a contributor to health and performance. And I think, so many financial institutions over the past 10, 15 years have said, oh, yeah, we have to help people manage their money better. So let's create a section on our website for financial literacy and then put up all this material. And worse, they'll do things like, well, answer these 10 questions to find out how financially literate you are.
On a scale of 1 to 10.
You can be a 10 out of 10. You can be 99 out of 100 in terms of literacy. But if your behavior sucks, then your health and performance sucks. And it isn't about how much money you make necessarily, because here's the other fallacy a lot of people have. People seem to think that everybody who makes $50,000 a year has lower financial health than people who make $150,000 a year. And guess what? It's not true, because you can be a retiree with only $50,000 of income because you have $10 million of savings and investment because you're retired and your income is definitely going to be lower. You also might make $50,000 and be perfectly happy living the lifestyle you do versus somebody who's making $150,000 a year and spending it way out of proportion on who knows what. And so the whole notion of literacy is focusing on the wrong thing. We need to be focusing on behavior and performance. And so financial health is not a new concept. But here's the problem, is that we tend to think about financial health in a binary way. Are you healthy or you're not healthy? It's a spectrum. There's no question, Glad, no question that there are too many people at the low end of the financial health spectrum. It's not just because of the amount of money they make, it's also about their behaviors. But at some point, they, with good guidance and change in behavior, and perhaps change in actually income levels as well, and change in spending behavior, you start moving up the health spectrum. At some point, you don't even think about having a financial health problem. You start thinking about, well, how do I optimize and maximize my performance? Bill Gates doesn't worry about financial health, but I'm sure people who manage his money are still focused on performance. I'm sure they don't go back to him and go, yeah, we put all your money in a 0%, savings account, Bill. So, you didn't, not that he'd care at that point, of course, but I'm sure that they don't do that. They still look to maximize and optimize performance. Even at the individual level, and for us normal people who don't make $1 billion a year or have it, we still focus on improving our performance. So where this is moving to, Vlad, is a focus on financial health and performance, where we'll start to quantify. One of the things that has always, amazed me is you can go to the doctor, you go to the lab, and can take a few drops of blood, and within 24 hours have 50 to 100 different scores for various aspects of your physical health. We have no way in North America, generally speaking, although there are some companies working on it, to manage or to measure rather financial health other than our credit score, our FICO score, which really only measures credit worthiness. It doesn't measure a lot of other things. There are other aspects. So where we're evolving to, and there's companies working on this, I still think we're very, very early in this, we're going to start to see more granular measurements of various aspects of our financial health and performance. It cuts across things like saving, investing, insuring, and spending, and all these various aspects of it. But we need scores. We need to know how are we doing on these things so that bank marketers can then come back and say, okay, let's go address the needs of people who are not insuring themselves enough, or those who have spending problems, those who have saving problems, or underperforming on investing. And I think, and I couldn't speak to Canada, but from a U.S. perspective, I think a lot of banks have got to get their act in gear on this, because I think we're going to get to a point here in the U.S. where the government's going to mandate this. I think the government's going to come back to banks and go, you have to prove to us that you are helping to improve the financial health of your customers. And they're going to do that, and the banks are going to go, how do I prove that other than, through quantitative, anecdotal ways of doing it? So, we're going to see an acceleration of this, but it isn't about literacy. It's about behavior, health, and performance.
Would you say that there's some correlation between the access to information right now that people have about financial matters and their behavior?
My first reaction is say no. I think there are people who may have a lot of money, don't manage it well. Not that they don't get enough information, it's that they don't make the behavioral changes. Man, it's hard to look. People who smoke generally aren't unaware that it's not a healthy thing for them, but they don't change. People who are not physically fit don't know. It's not that they're unaware that they should be exercising. They don't. It's not an informational problem. It's a behavioral problem. And changing behaviors is a hard thing to do. And it's actually one that most marketers are not really trained to deal with. This is part of the challenge from the marketing perspective is, marketing tends to be a unidirectional, messaging type of function. It's not a coaching behavioral type thing. And that's why, many of these so-called money coaches are filling an important gap. But I got to tell you, Vlad, some of the stuff that's on TikTok is very questionable. I'll give you a good example. I saw this video, and it was this guy sitting there with his wife, and he says, let me tell you my investing strategy. So I buy a stock when it's here, and then I watch it go up, and when it gets to here, that's when I sell it. And I saw this, and I was laughing uncontrollably. I thought it was really one of the funniest things I saw. And I, mentioned that on Twitter. People said, that guy was serious. He wasn't joking. He was really, and I'm like, you gotta be, that's like the most ridiculous thing. So part of the problem with, some of the social media stuff is that while there is a lot more information out there, it's not all good. And we're now at a different problem where, we're trying to put more information out there. We need another party to come along and rate the information, how good is this stuff? So there's some challenges there, but to go to your question, the literacy, it's about behavioral change, Vlad, and we're still learning as an industry how do we really engender behavioral change versus just pushing messages and information out there.
Right. And I totally agree with you. The quality there has to be a certain amount of responsibility that's enforced, I think, for anybody who's putting that kind of content out there, because it has significant implications. And I think this only underlines the opportunity for financial brands or credible sources of information to make themselves present, and to occupy that gap and to deliver information in a credible way. Because, social media aside, the internet as a whole, you have to be very careful with understanding and interpreting things as true or not true or somewhat true, right? I think the overall concept of where I see things are going is, and just like you mentioned, the smoking example, a lot of people are more willing to quit smoking now that they do know how bad it is than they were perhaps in the 70s, when they were just when that information simply wasn't available to them. So I hope that trend, somewhat continues. But you mentioned a very important aspect about financial health and the scoring of it, and how preliminary really we are to it, especially when you consider other health scores that are out there. So if we're in a situation where a person is able to get a health score, and perhaps the financial institution or some AI or fintech technology out there is able to calculate a set of steps that you need to follow to improve your financial score, what is the role of AI, and how disconnected will we as individuals be from making really our own decisions, as opposed to basically trusting a machine and a calculator and a financial brands to tell us really what we need to be doing with our money?
There's a couple of questions I think you had in there. One being around the role of AI. And I think in the shorter term, the role of AI for financial institutions will find its way in to a lot of areas other than sort of financial health and financial health measurement. There's still a lot of room to utilize AI for fraud management, risk management, even in terms of marketing stuff. Although I'll tell you, I'm not sort of real optimistic that AI is going to be this silver bullet magic thing that's going to help us provide all this great advice that we're going to deliver through AI. But there's a lot of functional areas within banking that will be able to make use of AI, even within IT function itself, long before it makes its way into marketing and financial health.
Well, just in general, with the financial health and improving the financial health score, if we as consumers are becoming much more reliant on technology to tell us what to do with our money, are there any downsides to that?
Yeah, we have to take a step back and recognize that, very high level, and this is very kind of generic. There tends to be, three types of people out there. Those that kind of want to do it all themselves. They're going to willing to do the work. These are the people who've been using, Intuit for the, manage their money and, for the past 20 years, that kind of stuff. And there's people who, are very self-directed, willing to do the work. At the other end of the spectrum are those that just say, well, go do it for me. And, from an investment perspective, they work with advisors who just do it all. And now, thanks to some of the democratization of some of these tools, and bringing it down to a lower cost point, like again, I mentioned some of the savings tools like Digit and Capital that just move your money, or you get some of these robo advisors that just we'll make it money, and there are people who do it, but there's this middle group that's really being overlooked. They're kind of like collaborators. They're not totally self-directed, and neither are they totally delegators. They want help. They do want to do some of the work, but recognize that they either can't or won't do all of the work, and they're not comfortable just turning it over to somebody else. And so there needs to be kind of this middle ground. And here's where AI can help is, have you seen these chat bots that tend to be more customer service oriented these days? But we need to kind of combine the customer service type chat bot with the robo advisor type chat bot. Today robo advisor is not a chat bot. It's just really algorithm driven. It's, hey, let's go figure out where you should be investing and just go do it. But that doesn't allow for somebody to say, well, why? And what if I don't want all of that? And what about this? And how do you feel about that? So we need some, AI can really kind of provide some better service to this middle group who really want to be more collaborative in the management of their financial lives versus either totally self-directed or totally delegating.
So I think the investing space is a good example of the mixed bag of these types of individuals where we either want to invest with a robo-advisor or do some of our trading on our own, right? Like apps like Wealthsimple, for example, is really popular here. Robinhood has been in the news. Do you find that a company like Robinhood got, they weren't the only brokerage that was in that position when a few weeks ago, the entire fiasco went down with GameStop and trips to the moon and whatnot. Like, do you feel that they were just got caught because they were one of the bigger players, or what were your initial feelings when you heard about those stories developing?
That it exposed the weakness of their business model. They came in with this, hey, we're free, we don't charge you commissions, and everybody else, ultimately had to, or a lot of other players ultimately had to kind of concede to that. But those other firms, like the big ones, Schwab and Fidelity, they didn't rely strictly on payment for order flow like Robinhood did. And on top of that, in terms of the margin requirements, what Robinhood was just way out of line compared to what a Fidelity, Merrill Lynch, or or Charles Schwab might have. And so the debacle kind of exposed the weakness of Robinhood's business model more so than anything else. I don't think they were evil in doing what they did. I just think they've been poorly managed in terms of the execution. Their messaging during the debacle was absolutely horrible. But on the other hand, they found themselves between the rock and the hard place, and had to react the way they did. That I don't think any other management team would have made any other decision at that point in time. But a better management team would have had better foresight into, where is this thing heading, and what would happen if XYZ happened. Right. And boy, we'd be really screwed. So let's go take some steps to prevent that. Really poor, risk management, because any good risk manager would have been able to kind of foresee the problems that they didn't foresee.
I watched an interview the interview was on YouTube, but it was from the Clubhouse app. And it was the interview between Elon Musk and the CEO of Robinhood. His name is Vlad, actually, by the way, as well.
Yeah.
And Elon was basically asking him, like, what happened? Why did you stop the trading, right? It was really interesting to see him in that interviewer mode. But the answers were essentially that there was a requirement by the clearinghouse with all this volume of trading came in that they had to pay, I think, $3 billion or something like that because of this super large amount of trading. And the company up to that point had raised a total of $2 billion. So they basically had no choice, at least based on that explanation. Is this something that could have been prevented if they had that foresight that you mentioned?
Oh, yeah, absolutely. If not prevented, at least foreseen. Good risk management should have been able to say, okay, what if this happens, or at what level? And there was no foresight on it, and there doesn't seem to have been any trigger that said, hey, wait, this is rising to the point where we're getting close to a margin requirement that we're not going to be able to pay out on. Yeah, and so that's what I'm saying, is that it absolutely should have been, this was a foreseeable event, and with better risk management and risk controls, there should have been triggers that would have kicked in long before it got to the point that it did.
What subsectors would you say are further ahead, and which financial subsectors are lagging behind in terms of integrating fintech into their day-to-day business?
If we look at what's happened in the past 10 years or so, a lot of the approach to fintech has been very kind of front end user interface focused. All these emerging neobanks, the digital brokerages, and so forth, even some of the insurance companies and things like that. It's been very much about changing the user interface and the user experience. But to a large extent, the stuff behind the scenes, the financial infrastructure, has not been changed. The payment rails, like what's happened with the drivers behind the whole Robinhood debacle, has a lot to do with having clearing houses and having T+2 trading, the lag in terms of not being real time. And I think what's happening now is more fintechs are coming in to address the infrastructure, the problems with the payments rails, the problems with the clearing houses, the data integration issues that the industry has, both within a corporation, between corporations, and between corporations and government and non-financial entities. So to me, we're going from, I hate to put labels like FinTech 1.0 and 2.0 on it, but I think what's really changing is a focus now on the real unsexy parts of the financial system, the infrastructure side of it. Definitely not sexy, definitely not things that the general public sees or knows about or cares about, but they care. Oh, they will care about it when they start to see, oh, stuff's moving faster.
Yeah.
This is more convenient. And part of the problem for slow movement of stuff is not because of user interface, but because of the infrastructure. So I think that's the piece that has been slow to be impacted, is the infrastructure, as so much of the fintechs that have come up in the ranks over the past 10 years have focused more on the interface and experience.
Would you say that different sub-industries are more aggressive with adopting fintech than others? So, I mean, for example, the lending or credit space, the insurance space, investing or payments being different sub-industries. Do you see some that are going further ahead than others?
You've got players across the board who've been aggressively changing things. It tends to be more about the consumer level of adoption that drives that versus it's the demand side that's driving the degree of change versus the supply side. I think we've seen plenty of players across the supply side, but especially when it comes to payments, there's been slower adoption for some of these things, other than person-to-person payments, when there was really nothing there other than checks and cash. But we've had debit cards and credit cards for a long time, and experience isn't that bad. You got to pull a card out of your wallet and swipe it, but is that really that much worse than having to pull up your phone and put it next to a payment mechanism?
Right.
And now there are stores like Amazon Go where you don't pull out anything. You just scan your thing into the shopping cart, bag it, and walk out. So, but we're still a little bit further away from that. So the relative speed of which the sub components of the industry are taking hold has a lot more to do, in my mind, with consumer adoption of it versus having the ability to from some supply side.
Ron, you gave us a few good trends in the banking and the financial space in general, but can you talk about fintech in particular? What are your top 3 trends that you see on the horizon for the fintech industry?
I'm not even sure I can get to 3, because I think there's one that kind of overarches a lot of what's going on, Vlad. And I kind of alluded to it when I talked about the focus on the financial infrastructure. I think one of the big trends that is going to really take hold is kind of across a lot of different areas, is what I think of as sort of the disruption of the value chain. And here's what I mean by that. For all the stuff we've had in fintech for the past 10 years, the process of payroll still has remained almost unchanged. We have an employer who puts money in, get to a payroll processor who figures out where to send that money and which bank account to send it to. But the needs of consumers are really different. Think about it, Vlad. Why does a company have to pay another company who puts the money in another company's account for me to get my money and then send it to a bunch of other companies to pay my bills? Okay, this is the value chain, right? Employer, payroll processor, the bank, the consumer, to billers. Why not cut out a few of those processes and somebody pay my bills for me?
Right.
I pay it every month. It's the same thing. And by the way, have an AI-based tool to actually review my bill to determine, is it the same as it was last month? If it's different, does it look right? Were there charges that were added to this that might not be right, that might flag something for me, and then say, hey, Ron, we didn't pay your cable bill automatically because we detected some anomalies. Please review this. So this is, now think of it, you're a small business. You're collecting money through all these different payment mechanisms, invoicing consumers. Again, it's cutting out a lot of the pieces of the value chain. And I think, this is why I say, the infrastructure piece is one component of this. This is not infrastructure per se, but this is cutting out and automating pieces of this value chain in a lot of different areas that hasn't been addressed yet, because so much of the focus has been simply on user interface and experience. To me, that's the big trend, and it cuts across so many different areas. I can't even begin to think of it. Payroll being one, small businesses being another. Even think, I'm sure there's ways you think about, this notion of embedded finance with you're buying something, you're buying a car. Why are you buying just the car? Why aren't you buying insurance at the same time that you're buying the car, or you're buying a home? There's so many other things that need to be done at the point of buying a home. Why isn't Zillow just doing it all? And I'm sure that they're thinking about this because this is their business. This is where I think the trend for the next, 10 years is that, the reinvention of the value chain in so many different areas. And then the other thing that I would point to, and as a longer term trend too, is, I would not dismiss cryptocurrency and Bitcoin, and I would not put Bitcoin as just simply a speculative asset. But there's just, so much that can happen there. I can't even begin to, think of the potentials of how that will evolve. But, as blockchain becomes, more not widely accepted, that's really not the way to think about it. But as the use cases for blockchain become more mature, and they already got, like, JP Morgan Chase 2 years ago announced JPM coin. Why? Because they want consumers to use it? No. It's a way for them to enable cross-border currency movement. So a lot of this non-sexy stuff, that is where a lot of this fintech stuff is going to happen.
I think it's funny that you mentioned cryptocurrency. I hear one of the main things that I hear from people that are not on the cryptocurrency bandwagon, so to speak, is the lack of understanding of how it works. And me, myself, I've read so much about it. I'd like to believe I somewhat understand it, but do I actually understand what it's all about and how it works? Not at all, right? But that's, to me, I compare that to a telephone. I mean, I can pick up my phone. I know how a phone works. I know that I can push a few buttons and talk to somebody 10,000 miles away, but I don't have any actual understanding of what happens behind the scenes and how is it all possible, right? And how is it actually working? So there is a lot of different opinions about it right now. But from what I understand, you believe it has a true place in the financial ecosystem, and big brands are starting to move and invest into it already.
It's a confusing space, and I think part of the challenge that a lot of financial institutions have at the moment is that the so-called experts in cryptocurrency are not necessarily all legit people, and there's just so many different aspects of this. It's cryptocurrency again for different purposes and different use cases and so forth, and it's confusing. I'm just trying to keep up with it too, and trying to figure out, okay, so non-fungible tokens, what does that mean? What does it do? It does seem to me that a lot of these cryptocurrencies in the market are nothing more than self-created things that people trade and invest in as purely speculative things. It's a sport almost, as much as it is anything else, and that's fine if that's what you want to do. It's like betting on horses. You've got no control over it. You can study it and think you know how one horse is going to perform on any given day. How is that any different than looking at the ups and downs of the cryptocurrency market? You know what I mean? So it's a sport, it's a game, and if that's what you want to do, and that's then fine. You can make some money and lose some money doing that. So, but in terms of sort of having a financial system impact, I think most governments will one day get to the point of having digital fiat currencies, and it'll be well managed and won't have a horrible impact on existing financial institutions, because it will be designed to not have a negative impact on existing financial institutions. But it does feel like there's this fringe aspect to cryptocurrency that is nothing more than sport. And you want to do it, then you get into it. It's no different than fantasy football, right? You got to pick your players, and you make or lose money on that every week, whether or not you pick right. No different.
You've answered so many questions, and you've given us so many interesting insights on the different subjects. Is there something else that you would like to talk about that we haven't really touched on, but it's important to you?
Well, I'm a big Grateful Dead fan, but I don't think that's what your audience wants to talk about. So no.
Next time.
Listen, maybe next time. But listen, no, I think we've touched on so many different things. We've been going now for well over an hour or so. So I hope people find this helpful, and I hope they find it sort of thought provoking. Is really what I would hope they come away with. Because listen, I do follow this stuff closely, but you know what? In the end, these are my opinions, and as my wife would tell everybody, I'm often wrong.
No.
Yeah. They keep me, and my daughters. Oh my gosh, I'll tell you a quick story. It was ranked, one of the top fintech influencers by a magazine a couple of years ago. My daughter was probably about 15 at the time, and she happened to be walking by as I was looking at this. I said, "Hey, come here, take a look at this." And it was like, "Wow, Ron Shevlin ranked number 2 influencer." She goes, "Yeah, great. Too bad you're not influential around here."
Oh man.
I was like, so they keep me honest. But no, I hope people get some value out of this. I hope it makes them think, and not to just accept all the viewpoints that are out there as gospel, because the world is changing in financial services. Nobody's got the right answer. All these influencers and futurists saying, here's what's going to happen. They're wrong more than 50% of the time. The problem is figuring out which 50% is right and which 50% is wrong.
Ron, I think you are more influential than you think inside your family, because that response, it was very snarky, and I know that's part of your brand. So
there you go.
You're on point. If people want to find more of your content and discover you online, what's the best way for them to do that?
A couple places I would hope people will check out is, first, go to Forbes, search for the FinTech Snark Tank. It's in the FinTech section of the money section on Forbes, which is one of the big sections. And then I'm always on Twitter at rshevlin, RSHEVLIN. And of course, if people want, love to connect on LinkedIn as well.
Ron, I want to sincerely thank you for making the time today to speak with us. And I hope you have a great rest of the day today.
Thanks, Vlad. Thanks for having me on.